Welcome to the deep dive. Today, we are really cracking open the growth machine that is Amazon. And we're not just looking at its recent stock performance. We're doing a meticulous dive into the company's dual growth engines and asking a pretty fundamental question. Is the current investor skepticism about Amazon's future? Well, maybe wildly misplaced. It's a fascinating time in the market, really. Over the last couple of years, investors have absolutely fallen back in love with big tech stocks, especially those, promising high returns from artificial intelligence exposure. But there's this paradox kind of hiding in plain sight when we look specifically at Amazon. Despite being one of the largest, most successful companies on the planet, Amazon stock, well, it's severely underperformed the broad market S&P 500 index over the last 5 years. Think about that gap for a second. Amazon's up less than 40%.
Yeah, less than 40%.
Compared to a total return of 110% for the broader S&P 500 index. How can a cornerstone of the global digital economy be lagging by such a massive margin?
Well, what's fascinating here is that the market seems to be struggling. It's struggling to reconcile Amazon's incredible operational legacy with its perceived position in the immediate AI future. The investment community's focus is laser sharp right now. It's fixated on which companies are winning the AI race. And Wall Street is inherently wary, maybe skeptical, about Amazon's ability to keep up. And that leads directly to that significant underperformance you mentioned.
Right.
The concern is pretty simple. If you're not seen as the number one sort of infrastructure provider for the next generation of AI giants, you're punished. Simple as that.
Exactly. So our mission today is to thoroughly examine the argument presented in our sources. It's kind of the counter-narrative, which says that Amazon is, in fact, one of the smartest long-term growth stocks available today. And this thesis rests on two core, potentially accelerating growth engines. You've got the cloud business, AWS, which faces these headwinds we talked about. And then there's the massive, often forgotten retail engine, which is undergoing, well, an unprecedented transformation. So let's start where most of the skepticism is concentrated. Cloud computing, Amazon Web Services, AWS.
It's giant.
Yeah, the undisputed heavyweight champion, right? Dominating cloud infrastructure for nearly 2 decades. Revenue, profitability, everything. But the narrative holding the stock back is that AWS is falling behind in these key AI cloud relationships. The suggestion is that in this new generative AI era, the competitive risk is significant because AWS's rivals are capturing the biggest, fastest growing AI startups. Is that fair?
That's certainly the perception. And we can actually quantify the market's concern with some raw numbers. Right now, AWS's quarterly revenue growth rate, it's about 17.5% year over year, which is, solid in isolation.
Solid, yeah, but context is key.
Exactly. Look at the competition. Microsoft Azure is accelerating at 29%.
Wow.
And Google Cloud is growing at 32%. That difference is, well, it's massive. You can't ignore it. The market looks at the difference between, say, 17.5% and 32% and immediately sees deceleration, lost ground.
Right.
And they ask, why are Azure and Google growing so much faster? And it seems directly linked to their relationships with these generational AI startups. Think of Microsoft's big investment in OpenAI.
Of course.
Those faster-growing rivals appear to be monetizing the initial infrastructure needs of the AI boom much more quickly.
So this raises the critical point, doesn't it? Will AWS lose its foundational lead in overall cloud infrastructure as this generative AI era fully matures?
That's the multi-trillion-dollar question.
Yeah, that single question, according to our sources, has put something like a $2.4 trillion cap on the company's valuation. If AWS deceleration continues, the whole investment case for Amazon starts to look shaky.
It really does.
But okay, let's flip the script now. Let's unpack the argument for why AWS might actually accelerate its revenue growth over the next few quarters. Defying this current skepticism and maybe closing that growth rate gap with rivals.
Okay.
This is where a key strategic catalyst comes into play. The deep relationship Amazon has cultivated with Anthropic.
Anthropic, right. A major AI player. They're quickly becoming a leader in enterprise AI deployment, focusing specifically on applications for large corporate customers, not just consumer stuff. And the growth numbers projected for this one company, they are frankly astounding. And they're absolutely critical to this AWS counter-narrative we're discussing.
They really are something else. Their annual recurring revenue, ARR, the predictable contract value they expect each year, it was only $5 billion back in August, which is already huge.
Pretty huge.
Yeah.
Yeah.
But get this. They are projecting a rapid climb to $9 billion by the end of 2025.
Oh, okay.
And then explosive acceleration to $26 billion by the end of 2026.
26 billion.
This isn't just fast growth. This is like breakneck speed scaling.
Absolutely. And the financial implication for AWS is crucial here. It links directly to the current economics of AI development. Because Anthropic is building these massive, complex language models and providing enterprise services, they are spending just a phenomenal amount of capital on computational infrastructure.
Right, the servers, the processing power.
Everything. They are, almost by design at this stage, losing a ton of money right now, just burning cash to build and scale.
Okay.
So what does that mean for AWS? It means that more than their annual recurring revenue will likely be spent on cloud services each year. Maybe double or triple that ARR number just to keep the lights on, keep training models, keep serving customers.
Wow.
And AWS is a primary provider for Anthropic. That's key.
Okay, wait. I have to pause on that point because it sounds like,
Mhm.
well, a genuine risk.
Yeah.
If we're relying on an AI startup that is aggressively losing money to drive AWS revenue acceleration, doesn't that make the AWS growth forecast kind of dependent on a potentially fragile, high-burn business model?
That's a fair question.
Is that a calculated risk worth betting the farm on?
It is a calculated risk, yes. But you could argue it's a necessary one in this current environment. The key isn't Anthropic's profitability today. The key is their demand for infrastructure, which is for all intents and purposes guaranteed in the short to medium term given their funding and contracts.
Okay.
And when we run the numbers, the potential impact of just this single relationship is immense, especially in the context of Amazon's current scale. Think about it. AWS has $116 billion in what we call trailing 12-month revenue, TTM. That's the past year.
Right, $116 billion.
Now, if we estimate, conservatively perhaps, that Anthropic will spend potentially more than $10 billion on AWS cloud services in the coming quarters.
$10 billion plus, just from Anthropic.
Right. That single influx provides incredible leverage. Now, it might not seem huge compared to the $116 billion base.
But as new growth.
Exactly. As new high-velocity revenue, $10 billion can easily help accelerate AWS growth above that crucial 20% mark we talked about.
Yeah.
It could quickly help close the perception gap with Microsoft and Google.
And if you look beyond just the next few quarters, the long-term view for AWS remains massive, doesn't it?
Absolutely. The entire division is still projected by many analysts to reach something like $200 billion in revenue by the end of the decade.
$200 billion.
So if they successfully land these key AI infrastructure relationships like Anthropic and potentially others, the current deceleration really could just look like a minor blip in hindsight.
Okay, that's a compelling case for AWS potentially reaccelerating. Let's transition, though, because here's where it gets really interesting, I think. Investors are so hyper-focused on the AWS story and that whole AI race.
Understandably so.
Understandably, yes, but they might be completely missing the original online retail business, which, according to our sources, is still being profoundly underrated in valuation models.
The forgotten engine.
Exactly, the forgotten engine. We're talking about an absolute behemoth that has quietly shifted its focus from pure sales growth to, well, profit extraction. Amazon's e-commerce network. It has built this vast, almost insurmountable competitive advantage in North America.
The logistics network.
Yeah, why? Because of its unparalleled speed of delivery and its highly vertically integrated model, it just allows it to consistently swallow market share.
And the numbers, they confirm the underlying stability, right? North American retail revenue grew 11% year over year last quarter. That's to $100 billion.
$100 billion in a quarter, just North America retail.
Yeah. And crucially, that growth was matched internationally.
Yeah.
11% constant currency growth outside North America, too. So this isn't some stagnant legacy business. It's still a steadily growing global commerce platform.
But as you hinted, the real story isn't just the top line anymore. The real shift is in profit margins.
Exactly.
And this transformation is being driven almost entirely by automation and AI efficiencies across the entire supply chain. This is where the magic is happening, apparently.
Absolutely. I mean, think about the sheer complexity of that operation. This margin improvement, it's like a team effort across three major areas. First, you've got AI-generated advertisements on the site, highly profitable.
Right.
Second, robot-powered warehouses and really optimized fulfillment zoning. That drastically reduces logistics costs, the cost per package shipped.
Huge impact there.
And third, the constant fine-tuning of labor schedules using AI plus AI-driven search enhancements on the website itself, which cuts down on things like customer support costs and returns.
It all adds up.
It really does. And these efficiency gains are showing up in one critical metric, the operating margin for retail. Amazon's operating margin in North America for retail. It was only 7% over the past 12 months, the TTM figure.
Only 7%. That sounds low for such a dominant player.
It does. Historically, it was much lower, even negative sometimes. But that 7%, that's the starting point for this new phase. That number is expected to climb significantly higher in the years to come as that relentless automation really takes hold. It could push well toward double digits.
And every single percentage point increase in that margin
Translates directly to billions and billions in operating income just because of the sheer scale of that, $400 billion plus annual retail revenue base in North America alone.
So it essentially means the retail segment is morphing, right? From a low-margin growth engine into potentially a high-margin cash cow.
That's the thesis.
And the market isn't fully pricing in the speed or the magnitude of that transformation. The heavy spending phase, the CapEx for building the logistics network, that's largely done.
It seems so. Now comes the harvesting phase, leveraging that investment.
Okay, so let's put it all together. What does this mean when we combine the potentially accelerating cloud engine driven by Anthropic and maybe other big AI deals, and this rapidly automating retail engine with expanding margins? How does this impact the company's overall valuation?
Well, this is where the argument for a significant valuation gap comes in. Amazon's current market cap is, only $2.4 trillion, which sounds staggering, of course.
Still a massive number.
But it compares, maybe unfavorably, to some of its big tech competitors that have already sailed past the $3 trillion mark.
Right.
The argument presented in the sources is that investors are discounting Amazon's stock far too much. Why? Because they don't fully believe in this upcoming profit inflection point.
That inflection point, that's the key term, isn't it?
It really is. The idea is that sustained growth combined with this margin expansion we've talked about should lead to a really radical profit inflection over the next, say, 2 to 3 years. Let's look at the basic math that underpins this investment thesis.
Okay.
Overall company revenue grew 13% last quarter. That rate is believed to be pretty sustainable thanks to the combined strength of cloud and the retail market share gains.
Okay, 13% growth sustained.
So if you take a 13% average annual growth rate, total company revenue would climb to around $855 billion just 2 years from now.
$855 billion in total revenue. Okay. Now profitability.
Right. So we have to make an assumption about the overall operating margin. It was about 11.5% over the past year, TTM. The thesis assumes this can increase to maybe 15% in 2 years.
Okay, a jump from 11.5% to 15%. Is that realistic?
Well, the argument is that it's entirely justified by the operational leverage being unlocked, primarily by that retail automation and efficiency drive we just discussed. AWS margins are already high, so the big lever is retail.
Got it. So 15% margin on $855 billion revenue.
Correct. And that combination, it leads to a massive jump in earnings. If you take $855 billion in revenue and apply a 15% operating margin, you end up with around $128 billion in operating earnings 2 years from now.
$128 billion.
Now compare that to the $76 billion in earnings the company generated over the last 12 months.
Wow, $76 billion to $128 billion.
Yeah, that's nearly a 70% increase in profitability, driven purely by efficiency gains and continued scale.
That is a staggering jump in earnings in a relatively short time frame, just 2 years out.
It is.
So when you look at the company's current $2.4 trillion market cap versus that projected $128 billion in earnings, the resulting earnings ratio starts to look quite cheap, doesn't it?
Especially when you compare it to its mega cap peers, yeah. It looks potentially very attractive on a forward basis.
Which supports the argument.
This is exactly why the sources argue that Amazon might currently be the cheapest of the so-called Magnificent Seven stocks. The market seems to be pricing the stock based on current anxieties, particularly the AWS deceleration story.
We're at the narrative now.
Rather than the near-term operational reality, which seems to be accelerating cloud revenue potential coupled with steadily rising retail margins. The value is kind of hidden in that operational leverage.
That is a powerful synthesis, bringing both engines together. So the entire long-term investment thesis really rests on two kind of non-negotiable pillars, right?
Seems so.
First, accelerating growth in AWS, heavily fueled by those massive infrastructure deals with AI leaders like Anthropic. That has to happen.
Pillar one.
And second, expanding profits in the e-commerce engine, fueled by relentless AI efficiency and automation, driving those margins upward.
Pillar two. Both need to fire.
Both need to deliver.
Absolutely. And the structural question for you, the long-term investor looking at this, is this. That North American retail operating margin, Climbing from the current 7% TTM level, that's maybe the true indicator of this profitability shift. How much higher will it need to go? Does it need to hit 10%, 12%, maybe even 15% eventually?
Before Wall Street really takes notice.
Before Wall Street finally acknowledges the profit inflection is real, changes its entire modeling structure for the retail side, and starts to close that perceived valuation gap with its peers. The operational reality might already be in motion, but the market perception just needs time to catch up.
Yeah. And here is a final provocative thought for you to explore as you consider this company, based on everything we've discussed. Which of the two major internal metrics we've talked about? Is it the aggressive $200 billion AWS revenue target by the end of the decade? Or is it that rising retail operating margin in the North American segment? Which one will be the first to truly signal to the general market that Amazon is, perhaps, a rock-solid pick for the long haul again?
Future potential versus current efficiency gains.
Exactly. Think about where the market will place its faith first, in the future potential of the cloud or the proven improving efficiency of the retail giant. That's our deep dive for today.